Hello, it is April 3rd, 2021. This is As the World Burns, and I'm your host, Randall Burns. The literature on international investing and diversification is a little confusing. There are folks like Warren Buffett that claim that international diversification really isn't that important, that the S&P 500 is perfectly adequate for providing diversification, and most investors shouldn't really look much beyond that, and a flat 10% in bonds is good enough. Now, there are others like Ray Dalio that suggest a different level of bond investment and also throw in some commodity futures into a commodity index into the mix. So the literature strikes me as just a little confusing. It reminds me of the state of general investment before Ben Graham published The Intelligent Investor in the late 40s. Ben Graham was Warren Buffett's mentor and was a major influence in his life. He called him more important than any other man in his life other than his father. In my program on non-traditional risk, I discussed a little why I thought more might be appropriate. Okay, right now there are literally hundreds, over 1,700 index funds, many of which are fairly low cost. Now, the thing is they sometimes differ around things like what country they cover or what region they cover. There are ones that are US focused, ones that are non-US focused. There's ones focused in Eastern Asia. There's ones focused in the EU. There's ones focused in developing markets. So you have some decisions to make on some of this. And the question is how to make them, okay? And what do you really want to use to make the indication, okay? Now, a lot of folks are familiar, say, with metrics like GDP, okay? And that's one that it's being pretty broadly used, but there's well-known problems with that metric that we were taught in economics class 101 at the University of Chicago, and there's literature has grown substantially since then. So the question really is like what indicators might indicate like how you want to allocate broadly a lower risk portfolio to minimize risk. This is something that Ben Graham really did tackle, and I haven't seen a lot of advance since then. I mean, I've seen some different variations, like Ray Dalio's all-weather portfolio is a little different than what Buffett is suggesting, for example. But there's a lot of and one of the other major problems with all of this is that political leaders fall into the practice of specksmanship. They will organize their society around producing certain metrics. In the case of the US, GDP is a metric that a lot of importance is put on, even when maybe it shouldn't be. GDP measures not just goods, but bads. A crime wave can cause an increase in GDP, or an increase in fires in a city. You can see an increase in GDP from an increase in fires, even though there's no increase in economic welfare. This is a problem, okay? This is a real problem. Now, the major metric meant to adjust for some of the failings of GDP is HDI. And I give you a link to that below. And one thing that's pretty obvious when you look at it, the US does not fare nearly as well by HDI as it does the GDP per capita, and even worse if you do the GDP adjusted by living cost. And then the gap becomes even greater when you adjust the HDI by inequality. And the US is showing pretty mediocre performance by that metric. Now, there's a real investment decision in terms of allocating capital across regions. What is the appropriate measure? Okay, I would argue that inequality adjusted HDI would be the best of those four choices. Okay, but this is a question, and it's a question that I'm really only going to open. I'm really only prepared today to start opening the discussion. Okay, it seems to me that countries with declining indicators in areas like stability, health, education are not a good long-term bet. As a general rule, when a country is advancing economically, its stocks are a decent bet. If it's declining and it's trying to get its act together, then its bonds are a decent bet. Otherwise, maybe not. And a lot of people seem to have forgotten that, when looking at the U.S., which started out with a really big credit card at the end of World War II, and I would argue hasn't since the mid '60s hasn't really been doing a lot with it as measured by metrics of its citizens' welfare. Okay, men's wages have been stagnant since the mid '60s. There's been an advance in women's wages, but it's been largely at the expense of them having children, which may be a false economy in the long run. And yes, there have been minorities that were excluded from the mainstream of the economy, most notably blacks, that have made some very real advances since that period. But we need to think carefully about what this all really means and what the real broad indicators are showing. Okay. And I'm not seeing a broad advance in the US in terms of human capital. The way one immigrant friend of mine characterized it, the leaders of the US seem to have the attitude that when they find something that's lacking in their human capital strategy, they can just import more people. And that may have worked so far, but I think it's actually worked at the price of making the problems worse in some key ways. And that may deserve to be some other videos at some point. But I'm going to, factors like substance abuse and public health efficacy and obesity are decent indicators that predict longer-term health and productivity trends. Gender ratio seems to predict movement towards authoritarianism, and in turn may be a decent indicator of political stability. And by that metric, for example, China has some real limitations as far as a longer-term metric. But the bigger question is just how might some of, we have a lot of data that just wasn't available in Ben Graham's days. And the question is how is this really useful and appropriate in making investment decisions? Okay. I would argue that modern data science is opening up a lot of new options in this respect. I'd like to know your own thoughts. I'm going to make a poll of major economic indicators, and I'll put it in the description below after this video comes online. The great hedge fund manager, Ray Dalio, from what I've read of his upcoming book, The Changing World Order, Why Nations Succeed and Fail, seems to be thinking in terms of these indicators and what they mean. I haven't seen him do that to talk about how this will affect his currency diversifications or his allocations across different countries yet. And I think that's the next logical implication. And there's really a data science project here to get this right. In the meantime, what I'd like you to do, I'm going to create a ranked choice poll, and I'd really kind of like your thoughts on what are the indicators that seem most useful and important to you in making these kinds of decisions. This is Randall Burns at The World Burns signing out for today. There will be more content every day. You take care.